Thank you guys for tuning in to another episode or video of Queens in Real Estate. I know it's been a very long time since me and Tamiko have uploaded a video, but today we're going to kick off a new month with a new guest. We have Brian, is it Baucom?
Baucom, yep.
Brian Baucom of Gill Mortgage.
Yep.
How you doing today, Brian?
I'm doing great. How are you?
Awesome. Glad to have you here.
I'm glad to be here.
You are the first guest of Queens in Real Estate. And I think we got some pretty decent topics to talk about today. Is that
Absolutely,
right?
we do.
So Brian is of Gill Mortgage. Brian, can you talk a little bit about yourself and what you do and know who you are?
So I would be what is called a loan originator. I've been in the real estate loan business for over 15 years. What we do is when you're going to purchase a house, and you're obviously using a great agent here like Shay, we do the financing end of it. So we'll put together your loan for you while Shay finds you the perfect home.
Okay. So pretty much you like the bank.
I'm like the bank, but we're not a bank.
Right.
So,
I would say that because I have to tell clients who don't know the lender, that's who gets you approved for the loan. So,
Yep.
All right. So we got a few topics we want to talk about, a few questions I want to ask Brian. That way you can get a better understanding of the home buying process, especially in today's market. This is gonna be one of two videos. So before I jump into it, I want to say we are in a office where we're right off the interstate, so you may hear a lot of traffic, you may hear sirens, so just bear with us while we give you guys this good content. So Brian, why is now a great time to buy?
Well, interest rates are still low. That's the main thing. If you go back over the last year or so, interest rates are at historic lows. They've never been as low as they had been. They have started to go up just a little bit, but if you compare it to 3, 4, 5 years ago, they're still much lower. So you're able to borrow money at a much lower cost.
Right. So when you say low, ideally speaking, what's a low interest rate? Like, what's the average interest rate?
Right now, the average rates are about 3.5%.
Okay.
If you compare that to a car loan,
Yeah.
they can go 3.5, 4, 5, 6, 7,
Yep.
8, even higher if your credit's not right.
Right.
It's an extremely low cost source
Okay.
of money.
So, you saying that the interest rate is very low, how does that help the buyer when the interest rates are low?
It keeps your payment low. The amount that you're paying, interest is the amount you're paying to borrow that money. That's the amount that the investor or the bank is collecting to loan you that money. So the amount that it's costing you
Gotcha.
to get that money is low.
So basically a high interest rate, meaning you're going to pay a lot more for a house.
Correct.
That, in comparison of you having a lower interest rate.
Correct.
Gotcha.
So if you want to do the math and the simple math, if you borrow $100,000, a 3.5% interest rate over 1 year is going to cost you $3,500. A 6% interest rate over 1 year is going to cost you $6,000.
Gotcha.
So it's a big difference in your cost. Yeah.
Gotcha. So Brian, can you tell me what's the difference between a pre-qualification and a pre-approval? I have a lot of clients, buyers come and say, hey, I'm pre-approved, and I get in, it's like, oh, it's a pre-qualification.
Yeah.
Got one more step. So explain what that small difference is between a pre-qualification and pre-approval.
Absolutely. So a pre-qualification is exactly what it says. We've qualified you initially based off of information that you've given us over the phone or in person. So that would be your income, money in the bank. We would go ahead and pull your credit. We always do that anyway. But it would be information that we collected from you verbally. Pre-approval, in essence, means that we've gotten that information verbally, but we've also verified it with pay stubs, bank statements, anything else that would prove or verify what you've told us. So a qualification is verbally over the phone, in person. An approval is verified.
Okay. And what all do you ask for when it comes to a pre-approval? What can someone expect to turn over to a lender? a lender?
Yeah, so your basic information is typically your 30 days worth of bank or pay stubs, 60 days worth of bank statements, your W-2s, and depending on the loan program, you could just need W-2s for the most current year, or you could need it for the last two, and then also depending on the loan program, your tax returns.
Gotcha.
And that's your basic.
Is it like 1 year tax returns? Or?
It depends on the loan program.
Okay.
There's some loan programs out there that we don't even need to collect tax returns. We can just verify it by ordering a transcript through the back door, and that's really about it. We try to make it as easy as possible for you.
Gotcha.
Having to collect as little amount as possible and still get you the loan.
Awesome, awesome. So Brian, what is the minimum credit score to get approved to get a mortgage?
That's going to fluctuate with loan program again. Ideally, you always want to have a 640 or higher. That's where you start to get the best rates. That's where you start to be charged the least amount of money. Guild mortgage will go down to a 600 credit score. There are not a lot of lenders that do that, but we do. And again, it just depends on the loan program, but there are a few loan programs that'll go down to 600. There's a couple that'll go down to 620. All of them go down to 640. But we offer hundreds of loan programs.
Gotcha.
Literally, so we can always find a loan program that we can find that'll fit you.
So ideally speaking, you're saying that, you know, you would recommend a buyer have a 640 under special loan programs or special circumstances, maybe a 600 is the
Yeah, we can always go down to a 600.
Gotcha.
So.
Gotcha. So can you explain just what you know, what I'm trying to say, the minimum credit score for the main loans that you have?
Yeah, so your FHA, your VA, all of those will go down to a 600.
Okay.
Conventional says they'll go down to a 600, but then you'll need to have additional resources. You'll need to have some money in the bank. You'll need to have a higher income or a lower debt to income ratio. But you know, different loan programs, they trigger acceptances at different levels.
So basically, the lower the credit score, you may want to have more positive things to offset it.
Yeah, you have to.
Yeah.
You always
Whether
have
that's
to.
being income, savings, perhaps, not too many new derogatory things on your credit. Yeah. And that's like I try to coach my buyers is, if we know you're coming in with a lower credit score, we need something positive to offset that so it can balance out for them.
Absolutely. Yeah, you have to.
Okay. Oh, this is a good one. This is a good one. In my experience, you know, many times we screen buyers and we say, well, do you have an idea where your credit score is? And they was like, well, Credit Karma says I'm at a 680 or I'm at a 640. So can you explain the difference of what they see on Credit Karma versus the FICO score and the score that you guys use? Because I hate to be the bearer of bad news when I be like, okay, when they pull it, it's something totally different. So can you elaborate on that for me?
The easiest explanation is you have different types of credit pools. You have a consumer version or a very soft pool, and that's going to be your Credit Karma, your Credit Sesame, FICO, all of those. Then you have a hard pool, which is going to be your mortgage. That's going to be the most intense credit scrutiny that you can have. So they look at a lot more versus a lot less in essence. Typically, you know, 20, 30, 40, 50 point difference between the two, but it is pretty significant. You just have to think though, when you're applying for a mortgage, you're probably applying for the biggest loan you're going to get in your life.
Yeah.
So it's going to be a lot of scrutiny. It's going to be, they're going to look at your credit very intently. And they're going to try to find any reason to not loan you the money or reason that you might not pay the money back. So if you have any track record of history of derogatories or, you know, things like that. It's
Late payments.
Yeah, late payments
Charge-offs.
especially.
Yeah.
Yeah, and they always look at the last 12 months the most intensely. So you in essence need a 12-month clean run on your credit. No late payments, try not to have any charge-offs, derogatories, things like that, collections. Yep.
So, we got 3 different credit scores. We got the Experian, TransUnion, Equifax. Which one do lenders typically look at?
All 3.
All 3?
Yep, it's 3 separate companies. You'll pull from all 3, and that's what generates your credit report. When you apply for a mortgage, though, they're going to use your middle score and try to make it as fairly as possible. They'll take your lowest score, throw it out, take your highest score, throw it out, and they'll use the one in the middle. So we pull from all 3 credit bureaus, and we'll use the middle score. It doesn't matter which bureau, but we'll use the middle one, and that'll be your credit score for the loan.
And I think that's a good thing that we're talking about this, because I know a lot of buyers and consumers, certain credit score sites like Credit Karma may only be using one of the bureaus or 2 of the bureaus. It may not be all 3, so you don't get a true sense of where you are.
Yep.
You may have Credit Karma where, with Credit Karma, I'm not sure, just as an example, Equifax and TransUnion may be only reporting to Credit Karma where you still have Experian. So it's very important that, buyers understand that it's the higher the better. Because the higher you can get your scores, it'll bounce out where your median score is typically high as well.
Yep, and the higher your score, that's going to affect you in every financial transaction in your life. Credit cards, you're going to get lower interest rates. Car loans, you're going to get lower interest rates. Mortgage rates, it affects everything in your life. So the higher your score, the better history you have at showing on-time payment, and that's the biggest thing. Show on-time payment. If you can prove that, your score goes up, and everything costs less in the financial industry.
Yes.
Not just your mortgage.
And I tell buyers that as well, and I'm pretty sure you probably do too, that you don't just want to do this to purchase a home, because you need to make it a habit, you need to make it a lifestyle, you need to make it a part of who you are, is keeping up with your finances. If you go ahead and start this, repairing your credit or paying your loans on time, and meeting those obligations when they're due, prior to you purchasing a house, all your expenses will eventually start to shrink. It'll start to shrink, and that also helps you to be able to afford more home as well.
Absolutely.
Because you're cutting your expenses down. Don't wait till when you're ready to purchase and say, now I got work to do. And then you still, after you purchase a home, going with those bad habits. You want to get ahead of it prior to you actually purchasing it. That way it becomes habitual. It's something that you can maintain, understand, and implement going forward.
Absolutely.
Yeah. So I get this question a lot. How much money would someone need to have saved, or what you would recommend? It
fluctuates on your loan program. You have your USDA rural housing loan that's a 100% loan, so you don't have to have a down payment. You're still going to have loan closing costs, so you're always going to have closing costs, and you'll always have a down payment. Your FHA mortgage has a 3.5% down payment, and then you're going to have your closing costs. So typically, you'll hear the number thrown out, 6%, 7%. That would include down payment and closing costs. But again, we offer hundreds of different loan programs. We've had a new loan program for FHA that's come online that does have a credit score minimum and some loan income restrictions, but it's a new 100% financing for FHA as well. So there are multiple loan programs out there that offer a zero down payment. But again, got to have that good credit score.
Right. They're not just gonna say,
Yeah.
no down payment or anything like that, and you at the bottom of the barrel when it comes to credit score. So
yeah, the FHA, the zero down payment, it's a 640 minimum credit score. A regular FHA will go down to 600, but now you have a 3.5% down payment. So it costs you more.
Right.
So again, it goes back to that credit score, and it costs you. You have so many more options.
So you just to be general about it, probably around 6 to 7%.
Yep. Yeah,
Okay.
that's always a good
of the sales price.
Yeah, that's always a good standard number. But then we can also find loan programs that would be possibly less than that because of a lesser down payment.
So if someone comes in and say, hey, I don't really have that many savings, you'll basically find a loan where, if possible.
Yeah, we'll try. It's when you come in and you have zero savings, one of the things that they're going to look at is what they call your reserves. So that's after you get the loan, how much money do you have in the bank? Because you have a payment coming up, in 45 days or so.
Right.
So if you don't have any money in the bank, that's also going to affect your chances of a loan approval.
Right.
Because not only do you not have money in the bank, but you're not showing you have money to make that first payment. So, that's just one of those things they're going to look at as well. So you want to have upfront money, down payment, your closing cost money. You also want to try to have a little reserves in the bank, unless you have a great credit score. And again, then they start to not look at those things as much. If you have a 610 credit score, they're going to want to see, do you have money in the bank? How are you going to pay it? What's your income? What's our risk?
Right. It's a measurement of risk for them.
It is. It's exactly what it is.
Measurement of risk. So, I'm actually, this next question applies to me as well as a lot of other people I know. And what is the pre-approval process? How is the pre-approval process different for those who are self-employed?
Okay. The pre-approval process is exactly the same. The actual application and credit report. The qualification, getting qualified for it, you're self-employed is going to require usually your 2 years of tax returns. So where if you're working a full-time job 40 hours a week and you have last year's W-2, we can usually go with that. If you're self-employed, they're going to look at a lot more items. So they're going to want your full credit reports. They're going to want to see what your income is after your deductions and all of that. And then they'll take the 2 years and they'll basically take the average, and that'll be the income they go off of. So all of your self-employed, your commission employees, things like that, they'll take an average of the 2 years.
So for those who are self-employed, sounds like you have to be self-employed for 2 years.
Correct.
And have your tax return, so you will have had to file your taxes.
Correct.
Any workaround?
No, not really.
Because I get that all the time. Is there a way?
Yeah.
Well, I haven't filed. Because self-employees, they do that last.
Yep.
They do that.
I did it too. I would file extension. October 15th.
Right.
I feel you. But when you go to apply for a mortgage, then unfortunately, you need to go ahead and try to get that tax return in. If you have, again, if you're showing substantial income and you have money in the bank, again, then the requirements are going to be a little less, and then they'll start to see,
Right.
You might start to see a little waivers in those requirements.
Okay, cool. So in cases where there may be a buyer and a co-buyer, do both have to meet the same requirements?
Absolutely.
Okay.
And the other kicker on that is when they take the buyer's middle score and the co-borrower's middle score, whichever one is the lowest is going to be the one they use for the loan.
Wow.
Yeah.
I did not know that.
Yep. So there can be advantages of having a co-borrower, or there could be a disadvantage of having a co-borrower. So,
right.
But sometimes you have to do that. If one of them has most of the income, one of them might have the higher credit score. I mean, or they just might have just enough income to kick you over the top. I mean, it just depends.
So basically, they both have to meet the minimum minimum requirements, but they can still sort of offset one another.
Correct. Yeah.
Okay.
The lower of the credit score would be the one that goes for the loan or for the application, but they can each have different situations. You know, one might have a lot of student loans, and the other one might have most of the income. You know, so then you're needing the income to offset the student loans.
Gotcha.
You know, it could just be, but unfortunately, the credit score, again, everything goes back to the credit score.
So do you think it'll be wise for them to run their information separately first before?
That's all part of the
Or you that's what you do
process.
anyway. You
yeah,
just run, okay.
Yeah. Well, it really doesn't matter, because even if we run them together, we can take one off after the fact.
Okay.
It's not very hard, and then we just rerun the credit report with the one. Again, it just really depends on the situation. If somebody's going to have a lot of student loans, you know, we can already tell that you know, that's going to hold back their income and their buying potential. You know, at that point, we might want to bring somebody on after the fact.
Right.
We have had situations where the husband and wife will call and say, okay, we want to buy a house, both want to be on the loan. We pull the credit. We could actually approve them with just one, which makes the loan process simpler. And then you can put both on the deed, so you still have ownership in the house while one's just on the loan. So
I should have wrote that question down. You just made me think that should have been one of my questions is when it comes to the deed. So now that how much time we have? Okay, we're gonna say that for another video. We about 22 minutes. I got one more question for you though before we wrap this one up. How does student loans impact a buyer's pre-approval process?
So that one's it does impact it. There's a lot of different guidelines and nuances and things like that with the student loans, but they always do affect it. It's not the end of the world. You want them to be current, so you know, make sure that you're either having them lumped into one loan, they can be deferred, or you can be paying on them. But they do affect the loan program. Each loan program takes into account for them differently. Some of them want you to use 1% of the total amount, and we have to take that 1% and put it as a monthly payment, so it goes against your income, even if it's being deferred. That would be an FHA, for example. A conventional mortgage, for example, now remember, conventional wants you to have a higher credit score, but then it's going to give you a little leniency. So the conventional loan program, if you're on an income-based repayment plan, and let's say you have $50,000 in student loans, which is common, but you're on an income-based repayment plan of $40 a month, a conventional loan program will take that $40 a month and apply that instead of the 1% or the $500. So it's a big difference, and it affects, you know, what you can buy. Again, the conventional loan in that situation, it's the best program to go, but if they're not going to look at a 600 or a 620. Matter of fact, they tend to want it to be closer to a 680 in that situation. So it just varies.
Okay. Well, I was going to say, so is it better to have them deferred or in forbearance? Because
it's really one and the same.
Okay.
You're still not paying on the loan. You know, so you basically have them deferred or in forbearance, or you're on an income-based repayment plan, or you're just paying standard. So
if they are deferred, and correct me if I'm saying this wrong, because I know if they're deferred, you're not obligated to pay, correct?
You're not currently paying on them.
So so each month.
But you have permission to not pay.
Right. Will it be best for them to get it on a payment plan so you don't take into account that 1%?
Well, again, it depends on the situation. If their credit score is not up around the 680, then we're going to have to take into account that 1%. I believe there's another loan program that'll do a 0.5%. So again, it just depends on how much you have. You know, if you have over $100,000 in student loans, you're going to need a higher credit score, because we're going to either use the deferment or the income-based repayment. If you have $15,000 in student loans, you're talking about $150 a month hit on your income. So at that point, it really doesn't matter, and you can use, whichever loan program.
Okay. Well, you guys, that is all the questions I have for Brian for this video. Hopefully you guys have learned some valuable information, and have some good substance. That way you could be more educated on the home buying process. You can use this video as a resource, because I know sometimes Googling a lot of information may be difficult, as it may be on a nationwide level, and different articles may say different things. But if you're in the Columbia area or the PD area, this affects this market, is more directed or precise for this market. But yeah, thank you guys for tuning in. Like I said, it's been a long time since I've seen you, so I'm glad to be back in front of you. Brian is happy to be here today to do this video. And that's about it. Until next time, peace.